As we reflect upon 2024, it's worth noting how many anticipated challenges failed to materialize. Despite widespread concerns about recession, market downturns, and political instability, markets demonstrated remarkable resilience. The S&P 500 reached new heights, inflation moderated, economic growth remained robust, and the Federal Reserve initiated rate cuts. How do we find balance in an evolving market? Looking ahead to 2025, the focus shifts from extremes to equilibrium. Looking back, investors have survived much volatility since 2020, which included both significant market declines and substantial recoveries. Investors now face a period that demonstrates a more balanced approach. While current market conditions appear favorable, several factors warrant attention. Stock valuations are exceeding historical averages, monetary policy continues to evolve, questions surround artificial intelligence's impact, and global tensions persist. These elements, combined with inevitable unforeseen events, will likely test investor resolve. To navigate this environment successfully, we can draw valuable lessons from recent market experiences. Here are 5 key insights to help investors maintain perspective as they position their portfolios for 2025. Economic resilience has boosted multiple asset classes. The economy has defied pessimistic forecasts, demonstrating remarkable strength. Inflation has retreated to 2.6% annually, while unemployment remains low at 4.2%. The economy added 2.3 million jobs over the last 12 months, and GDP growth exceeded 2.8% in Q3, surpassing expectations. This economic vigor has supported broad market gains. U.S. stocks have achieved record levels, while international markets have advanced. Bonds have recovered as rates stabilized, and alternative assets like gold have reached new highs. However, potential headwinds exist. Consumer spending may moderate as savings decline, and debt levels remain elevated across both consumer and corporate sectors. Assets that have experienced significant appreciation may face increased volatility, emphasizing the importance of fundamental analysis. Elevated valuations highlight diversification's importance. Corporate earnings have grown impressively, rising 8.6% over 12 months to $236 per share for the S&P 500. However, market gains have outpaced earnings growth, pushing valuations higher. The current price-to-earnings ratio of 22 significantly exceeds the historical average of 15.7. These elevated valuations suggest potentially lower future returns, emphasizing 2 critical strategies. First, investors should consider maintaining diversified exposure across asset classes. Second, with major indices at premium valuations, opportunities may exist in less prominent market segments. Market breadth has improved, with all 11 sectors posting positive returns year to date. Given the difficulty of predicting sector leadership, broad market exposure may help reduce portfolio volatility. Monetary policy shifts to supportive stance. The Federal Reserve have reduced rates by 1 percentage point, with markets anticipating additional rate cuts through 2025. While the exact timing remains uncertain, monetary policy has shifted from headwind to tailwind. This environment may benefit both stocks and bonds. Lower rates typically support economic growth and corporate earnings, while bond prices could appreciate if short-term rates decline while longer-term rates stabilize. Policy implementation takes center stage. Markets have responded positively to reduce political uncertainty following the election. However, significant policy considerations remain, including trade relations and fiscal matters. Historical data shows markets can thrive under various political leadership. Business cycles, which depend on multiple factors beyond politics, typically exert greater influence on market performance. While trade tensions and deficit concerns persist, these issues have historically not prevented positive market performance. The national debt has reached $36 trillion, yet markets have demonstrated resilience despite fiscal challenges. Success requires maintaining long-term perspective. The past year reinforces that markets can adapt despite prevalent concerns. Brief pullbacks in April and August proved temporary, as broader economic strength supported market gains. Historical evidence demonstrates that wealth accumulation occurs over extended periods. Even retirees benefit from maintaining a long-term outlook, which helps contextualize short-term market movements. The bottom line, while 2024 delivered strong market performance, 2025 calls for balanced portfolio positioning. Historical patterns suggest this approach best serves long-term financial objectives while managing unexpected developments.